This podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes.
As I said before, that accumulates over time. And in this case, what we found is we're able to effectively pay off their house 11 years sooner than what we were before. What we see is that over that 19-year time frame, we've actually been able to save $660,000 worth of non-tax deductible interest. If you do the maths at 47% tax,
big number.
That's a big number.
G'day everyone, and welcome to another episode of Wealth Toil. My name is Luke Laretive, and I'm here with my co-host, friend, and partner in crime, Dylan Pargiter-Green. DPG, how are you? Excellent,
mate. It's a beautiful sunny day down here in Hobart, recording from the home office.
Very, very sunny here in Torquay as well. It is the second home or first home recording studio today. Look, we've actually got a really interesting episode today. Talking about a client or a couple that we help, family, I should say, that we helped this week together, working through some strategies for their business and for their personal stuff, some investment stuff. Really, really interesting and useful case study. So we're going to go through that anonymized for the listeners today, and yeah, pretty typical of kind of the work that we're doing for people. So I'm hopeful that's going to be of use and interesting to people. What's been on your radar this week, Dill? Just give me a quick update.
Mate, just looking at the tax cuts from last week, which was pretty interesting. I think we might do a little bit of content on that in the coming weeks. A few client stories and dealing with the clients that we've been we saw earlier on Monday. Getting all the implementation.
Yeah, big job this one.
Yeah, it's a good one.
Bit of a big job. Mate, been a big week in markets too, so we might just quickly roll through to a little bit on the market or app, which we're going to try and make a feature of every episode. Now, we're not always going to record on the exact same day, but this is to Wednesday about 2:30 when I pulled these numbers off yesterday. We'll put the PDF in the show notes so you can check that out. ASX 200 is down about 0.5%. It's up a little bit today on Thursday, so probably about break even now. Has been a period for the last month or quarter or so where industrials have been outperforming resources and small caps making a bit of a resurgence as well. So something for us to keep an eye on and maybe have a chat about how to get some exposure to smalls and play that space as well, Dill, as we go forward.
Well, I was just going to say, like when we talk about that industrial sector, like, you know, give us a couple of reasons. What's the reasons that the resource has been underperforming, do you think?
I think, mate, to be fair, resource had a pretty good couple of years in terms of sort of that Russia stepping away from, I suppose, the energy markets, the coal markets, and the ag chemicals markets, which was pretty supportive of resources. I think further to that, you know, inflation is generally correlated with sort of high commodity prices. You know, you get high commodity prices, so you get higher costs and, you know, raw material costs, and that kind of feeds, you know, more inflation. So commodities and raw materials are a pretty important part of the inflation mix, and as a result, that's why we've had some of the inflation that we've had. We're just seeing that taper off kind of now with everything else. Chinese GDP and kind of the survey data, you know, the PMI type data has been pretty weak, and, you know, all reports coming out of that sort of black box that China's not doing too well, and they're sort of trying to stimulate their economy again over there. So that's obviously a drag for stuff like iron ore, copper, some of the manufacturing-based and industrial commodities. So yeah, that's kind of been why maybe resources doing a little bit worse. Why industrials is doing a little bit better is probably on the ASX, it's really the banks. And, you know, bad debts haven't been quite as bad. Rising rates have been able to sort of sort their NIM, you know, net interest margin, NIM for short, out a little bit or to a degree, and we think that's probably going to continue. So yeah, that's sort of been your two kind of barbells of why we've seen this industrials outperformance versus, you know, sort of the resources sector.
You know, I've got a cheeky smirk on my face because as soon as you start talking in anagrams, like not only does half or more of the listener base tune out, but I tune out because, like, you know,
Well, this is what I'm interested in. I'm a nerd. This is what I like.
You're a nerd.
This is my shit.
You talk your ABCs, your XYZs. You know, that's all you. And,
Look, there's one.
I love it.
There's one for you. There's one for you today, Dill. NIM, net interest margin, very important for banks and financials. Very, very important. All right. Anyway, so speaking of banks and financials,
big news.
Go on.
Interest rates were on hold.
Well, not really.
Huge. Who could have predicted that?
Everyone was all over that, right in line with consensus. $8 didn't move, 10-year bond didn't move. Nothing to see here. A lot of talk about the commentary, a lot of headlines grabbing about, you know, how they can still raise rates and they can still cut rates, and when are they going to cut rates? Look, market's pricing in cuts later this year. Market was pricing in 2 more rate hikes 6 months ago than what we got. So, like, let's not pretend the market's any good at forecasting the RBA or inflation. It kind of gives you a gauge, and the gauge is, and the takeaway for people at the moment is the trend for inflation is down. The bond market's telling you that we've had peak rates at kind of 5% on the 10-year bond, and they're now at kind of 4. They might go to 4.1, they might go to 3.9, but the overall trend is sort of down with inflation. So that's positive for markets, positive for equities, and eventually that'll put pressure on the RBA to do something about it and cut some rates. So while growth's still slowing, inflation's still declining, they're not going to be in a hurry to do too much. And for investors, that sort of stability and tailwind is pretty handy.
Very handy. It's funny, you know, we talk about rates with clients a lot. And I don't know whether you have these similar conversations, probably more market focused, but I still find it amazing that the RBA data that they use to make these decisions is more often than not 3 months old, or based on things that were happening 3 months ago. And then the effect of these decisions generally doesn't come through to, you, me, mortgage holding individuals for probably 2 to 3 months, because the bank announces it that they're going to do it. It then takes an effect, and then the following month it actually comes through. So, all this rate falls that are talking about later next year, the effect for individuals is actually probably not going to be until the start of 2025, even if these rate cuts happen later in the year.
And that's if the banks pass them on, right? The reality is the banks, we talk about net interest margins, right? So the banks have been competing, and they've been worried about this mortgage cliff that everyone's sort of hearing about, and these fixed rate loans that were written during COVID kind of rolling off. Now, let's say the forecasters are right, and we're cutting rates in August. Just going to pick a month, right? Like August. Well, the banks might actually say, well, you know what? We're just going to pick up that margin ourselves, and we're not going to pass all of that cut or any of that cut onto consumers. Now, there's a competitive tension there among the big four and the other providers in the market to be competitive on rates. But if they think that they can get away with it and they can pick up maybe 10 of those 25 basis points, well, they're going to do that because their margins are at kind of 5 or 6 year lows, 8 year lows actually. So they need the profit. Shareholders demand it, and certainly I wouldn't be surprised if on this part of the normalisation of interest rates sort of cycle that we don't see every basis point get passed on to mums and dads.
Imagine being the one out of the four big four that doesn't pass on the full cut. Like, imagine the media circus, the circus that 7 News would have on that.
I don't watch the news. I don't watch the news.
Well, for all the everyday people out there that consume their media not through TikTok like Luke Laretive, anyway, moving on. Let's. What's been the biggest surprise sector over the past sort of week or even this month?
Look, reporting season's kind of kicking off, right? So this is money time for me. This is where we make our living, and February's always February and August are the 2 biggest months of the year. From my perspective as a managing money. What's been surprising so far is retail, like just how strong retail's been. We had online luxury kind of, they call themselves a retailer. I call them a drop shipper, however you want to kind of describe them. Satire, code CTT. They were up like 25% this week on reported sales, up 89%. EBITDA, 22 million bucks, up 56% on last year. It's a super expensive stock. I'm not buying it. It's on 50 times EV to EBITDA. That's like, make your eyes bleed stuff for that kind of business, which is, what I'd argue is pretty low quality. But look, no doubt that people are still spending money on luxury clothes. Like, it's still a big thing. So, that was kind of surprising to me. I thought also the furniture retailer, which is a really high quality business, is Nick Scali. They're up 20% on pretty strong January numbers. They've had pretty average numbers, to be honest, recently, as you might imagine. But they saw positive sort of 2.6% like-for-like sales growth in January, which most of the market kind of reads through and says, oh, well, that's going to be the cyclical bottom of their earnings. They're starting to come out of what has been a weak period of growth for them. That's only on 6.5 times EV to EBITDA, much more interesting, right in line with its sort of 5-year average valuation. So that's maybe a stock that, we might have a look at because it's kind of coming off those cyclical lows. I can still buy it on an average valuation, but the earnings are going to go up maybe for the next 2 or 3 years. So that's a good opportunity for us to have a look at.
It's a little bit counterintuitive though, isn't it? Right? Like, again, media circus, not that you pay attention to the news, but people are supposed to have less money at the moment. And yet, you wouldn't say that people are going out and buying nice new dining tables and couches and those sort of things as much as they were 12 months ago. But
mate, I'm shocked. 2.6% like for like sales growth on this time 12 months ago. Like, we've had 200 basis points of rate increases. It's to me that's pretty wild to think that that's what they're doing better than they were last year on a like-for-like sales growth basis. So that's not, because they've rolled out stores or, grown the business some other way. That's actually just, comparable periods. So, yeah, look, it shocks me. It shows how, high-quality business Nick Scali is, really well run and, good cost management, all that kind of stuff. But, definitely not what the narrative, is counter to the narrative. And I think it's, a really good, thing to remember for people is sometimes like the data doesn't match up to what's in the newspaper. What the story is. The story is full of shit generally. Just follow the data.
Yeah. Don't believe the hype.
Get off the hype. Look, I'll try and be quick, Deal, because I've got one more thing I wanted to cover on markets, if that's all right with you.
Absolutely, man.
M&A activity. I think it's going to be a big theme of this year. Okay. There was an article that Buy Now, Pay Later Zipco, old Zip Money business, something I IPO'd way back when, 15% up on takeover rumours this week. They got a good US business that I think is a good asset for somebody. Larry Diamond, the old CEO and major shareholder, has been talking about this business being bought by a firm which is owned by Max Levchin, big US billionaire, multi-millionaire type cat. I think it'll go. I do think it's a good takeover target. Don't know what price it'll be. Don't know what the terms will be. Not sure if it's a good buy or sell at the current prices. We've looked at it and kind of given it a pass for the minute, but I'm not saying I wouldn't buy it. But I don't know what I've got to do some more work on it. And also Woodside pulled out of their merger with Santos, which is a big deal in the energy sector and the oil and gas sector. I still think this deal goes ahead. I think this is all a bit jawbony. Woodside, pretty conservative bunch of engineers over there in Western Australia. So I think that this will go ahead. There's value here. And, both of these businesses kind of need to do something because, Woodside's been trading at a massive discount to global peers of similar size and Santos been a massive discount to other energy cos on the ASX. So they got to close that discount somehow and maybe realising some synergy benefits here from these two pretty decent-sized businesses on the east and west coast of Australia, I think makes a lot of sense. And I'm sure someone can make the numbers work, which is probably what the only reason it's been, kibosh for the minute.
Yeah, interesting. It's funny that you talk about Zip, right? So thinking back to, I think Zip and Afterpay were the stock equivalent of like Bitcoin and Ethereum at one point, where everyone just had to have them. Everyone had to have them. It didn't matter whether you had $5 or $5 million. You had to be in them. And the amount of conversations that I'd had over that time where it's like, okay, but what do you think it's worth? What are you going to sell it at? It's a classic story, and now we look where Zip is, and potentially even Afterpay, which probably done.
I made, and the boys made, and the clients made a lot of money out of Zip. Right, we did really well. We were in there super early, and we did the backdoor listing for it, and yeah, we were there super early. And I only kicked myself. I told the story before, but I remember we met Nick Molnar from Afterpay like maybe a couple of months after we just put the Zip deal together. And I was like, no, I'm backing Zip. I'm sticking with Larry and Peter. Like those guys, didn't really gel with Nick. Didn't really like it, and could have had that stock pre-IPO, probably retired by now. But that's a story for another day.
Another day, we'll do a feature piece on Zip.
Feature story on Luke's 77 dumbest investments. Lack of investments. So
unzip the back door.
The reason Luke's not retired, number 547.
Dear. That's good. All right. So today we're doing a bit of a case study on a wealth management client that we both work with. For the purposes of this podcast, these people will be called John and Jane. I think we're going to have a fair few John and Janes throughout our time. And if you are called John and Jane,
we should have chosen funner names. Sorry.
Well, maybe I
blame Dylan for that.
We'll call
next
them
time.
Dylan. We'll call them Dylan and Luke. No, we'll call them John and Jane because that's what I've got written down. And look, it's a really good story. It's a really good story because these people have pretty broad scope of advice that we could deal with. Some really easy wins, and at the end of the day, they're in a really good position where some small changes relative to their overall financial position are going to make a huge difference to their long-term outcomes. And, like a lot of clients, these people have very, very standard goals. So we're talking things about security. We're talking things about long-term wealth generation, peace of mind. All of these things come back to, some of those core needs that we talk about. So, John and Jane, let's dive in.
All right. So John and Jane are about our age, well, my age, a bit older than Dill. They're in their late 30s, early 40s. Very nice people. They've got a fabulous business, and business turns over about 30 mil a year. They pull out obviously some nice profits out of that. Reasonably successful at what they do. They've got 2 kids, well, one and one on the way, and they live here in Melbourne. And yeah, so they've been clients of mine for a while from an investment perspective, and it's time they needed some fin planning and a little bit more strategy stuff. So, Dill, why don't you start talking a little bit about how we're going to kind of use debt recycling to pay down their mortgage a little bit faster, and just the sort of the mechanism of that, in a general context.
Yeah, for sure. So for those unfamiliar, debt recycling is the use of investment debt to grow assets alongside a mortgage or a principal place of residence. And then on an annual basis, taking the profits and any other contributions that we've made to that to then put that back through, so wash it through the principal place of residence and create a new investment loan, which we all should know that is tax deductible. So we've got the capacity to slowly reduce, or at an increasing pace, reduce the amount of non-deductible debt and increase the amount of tax deductible debt. Now, that might sound like a mouthful. There's a whole bunch of really, really helpful videos on YouTube that explain this with little drawings and things, which we might link to one or two if we can find one that we don't think is. I
always need a little drawing. Love a little drawing.
Yeah. I'll get Microsoft Paint open and we can do it on there. Then so these guys had a real standard goal is I want to be debt free on our house, right? That provides security. It provides a lot of things. And what we found is that they've got some money that's invested and there's no debt against that investment, but what they do have is a fairly significant mortgage on their house. The process of doing that is we take their existing investments, we obviously look at the capital gains implications, we sell down those investments, we pay off however much debt it is to start with, and then we draw back out that same amount in the form of a new investment loan. That investment loan then is reinvested in the same investments that it was before, or Luke may choose in this case to slightly change their investments. And what we've then got is we've got some deductible and non-deductible interest. As I said before, that accumulates over time. And in this case, what we found is we're able to effectively pay off their house 11 years sooner than what we were before. And the reason that we were able to do that was because we created tax deductible interest. Now, when you're paying top marginal tax bracket, what we see is that over that 19-year time frame, we've actually been able to save $660,000 worth of non-tax deductible interest. If you do the maths at 47% tax,
big number.
That's a big number. So
big number.
Two goals are achieved there. One is we've got greater financial security at a sooner time frame by not having to have a mortgage when they're in their 60s, let's say. And then subsequently, we've also got an asset that's building. So at that point, we can actually choose whether or not to sell down that asset and completely wipe whatever is left of the mortgage, or we can actually let it accumulate for another few years, potentially make some superannuation contributions, get it into a tax-free asset, and then pay that as they reach drawdown. It's a long-term strategy, but the benefit of it's huge.
I think this pretty much is like any high income earning couple with a mortgage who want to do some investing and kind of want to pay down their mortgage. Like, this is kind of a no-brainer. I think that this applies to a lot of households. I think there's a lot of people out there who don't do this, who just need some guidance every year and some help. It's a bit of an admin load. That's kind of my big takeaway from doing this is there's quite a bit of admin and sort of paper pushing that needs to go on every year, whether it's applying for a different loan, whether it's managing the interest payments, whether it's making sure investments are generating the kind of returns they need and doing all that kind of work. There is a bit of paper that slings around kind of to make this happen and get this gain. It's not a hands-off sort of thing unless you're employing someone like Dill and I to help you with it. So that was sort of that's been a pretty key driver of this particular financial plan and strategy for John and Jane. But not the only thing we've done for them.
No.
Dill, can we talk a little bit about what, like, I reckon these are naughty, right? Like, more people should do this if they're younger and can think forward about school fees. Investment bond for school fees. John and Jane are going to send these two fine young people to private school from year 5, and they're only year 1 and younger at the moment. But tell me why you want to use an investment bond and not just save the money or start a share portfolio or some other thing.
Because private school is expensive. It is expensive. What do you reckon?
Expensive.
And we're talking, the top end of private school. Not all private schools cost this much, but these guys are thankfully in a position where they can look at sending their kids to one of these schools. So, look, how much do you think that private schooling costs on a yearly basis?
Look, I know how much it costs. It's bloody expensive. It's about, I know 30 grand, right? You need 30 grand for a kid to go to private school these days.
Yeah.
Plus a few extras.
Yeah, absolutely. School trips, all the rest of it. But look, we usually model out from sort of year 5 or year 7 onwards, because that's the time when most parents think that they want to start sending their kids to these schools. It's when the largest statistical uptake in new students is. And what we want to do is we want to prepare families so that they have the financial capacity to actually, get through those years. So if you think about it, 30 grand, let's say it's from year 5 to year 12, 5, 6, 7, 8, 9, 10, 11, 12, 8 years, 8 times 3 is $240,000 that you're paying per child.
I'm glad you can do that kind of math.
Yeah, I did need to count it out on my hand. No. it's $240,000, 480 grand for 2 kids to go through school. It's a lot of money and it's a lot of cash flow. What we find is that if you're
it's after tax money as well. Like it's not
exactly,
it's not tax deductible. You can't run it through your business. So
no, actually,
makes it hard.
Let's try and find a way.
Yeah, it's more than that. You got to earn. You got to earn more than that. So I like these investment bonds because essentially it's tax deducting your school fees.
Yeah,
well, a little bit,
sort of, right? So an investment bond for everyone that doesn't know, it's a tax effective investment structure. It has some legislative benefits applied to the trust in which the investments are held in. They're more commonly in the past called insurance bonds, but now they're being called investment bonds. And there's a number of different providers out there. The key benefit is that because your investment returns within these structures are taxed at a lower marginal tax rate than your own, they have a maximum tax rate that can be applied of 30%. So if you're anywhere above that, you're guaranteed to get a better return than if you were investing directly through a managed fund. However, there are rules and restrictions on when and how you can access it, and also regular contributions. So they are a little bit more strict. I like to think of them as not quite halfway between superannuation and a regular investment, but certainly, closer to the regular investment side. You can still access the money, and particularly for private schooling, it's a fantastic way. So what we effectively did is we planned out the entire education journey of John and Jane's 2 children. We looked at when their school fees would need to be paid over that time frame. So we're talking 18 years, given we've got one child who is imminently pending, should we say. And what we did is we said, okay, well, let's take this right back to a weekly transaction. And I think the regular weekly savings amount was about $300, which is a lot more palatable than 30 grand at the start of every school year, or potentially over that period, you've got about 4 or 5 years of 60 grand coming through as a bill, which most people don't have, and they end up seeking debt finance or otherwise for that. We then mapped that out. We found that over that time period, we're able to get about $150,000 worth of projected investment returns using a relatively conservative number as well. And the overall tax benefit of being in the investment bond was a further just a tick under 50 grand. So that 150 plus that 50 or just under worked out to almost send one of their children through private school for free. So really,
if you're organised.
If you're organised, that's right. And they stick to the plan. But
if you already got them in school, it's a little bit tricky. But if they're not there yet, then it kind of works.
Well, look, it's an age-old saying for a reason, right? Like, fail to plan to fail. And these things are incredible when applied correctly. So, look, the benefit is not only there for school children. You can get your money into one of these and save for yourself. All the withdrawals after 10 years are entirely capital gains free, 100% capital gains free. If you want to pull money out of an investment in 10 years and not cop an enormous capital gains bill, maybe think about an investment bond. But,
like it.
Anyway, seek advice, right? Seek advice.
Like it. Yeah, like it. Asterisk, general advice, blah, blah, blah. Okay, can we get on to, because we've got 15 minutes to cover 2 topics, and the second topic I'm going to talk about with stuff that I'm interested in. So we've got to get through your stuff quickly now. You've got 10 minutes or less to tell the fine people about insurance. And I'll preface this by saying this is the most important part of this particular couple's plan. John is the key man in his business. If he doesn't do his job, the world ends. Jane can't step in and do it. No one else can really come in and do it. They got a lot of debt that's currently all still tied up with the business, and as is common with business owners, it's collateralized over here, and income's coming in over there. So having some insurance. John doesn't have any insurance at the moment. No life insurance, no TPD, no income protection. So this is really important. 2 kids, big mortgage, or decent sized mortgage, I should say. burgeoning business that's really relying on him still. Tell us about what we've done with insurance, because I think I know among my client base, business owners, it is, and particularly small business owners, where you're turning under 50 mil over, and it's all on, a little bit of all on you. It's so important, so important.
Absolutely. I mean, like it's one of the biggest neglect areas that we see. I would say, and like you said, business owners are the worst because they are so focused on their own business and driving that and winning at that they neglect some of the personal things and some of the risks that you have. So, look, really simply, insurance is important.
Remaining solvent.
Remaining solvent. But that's not a joke, all right? We need to have that conversation.
No, that is. We need. That's
but no,
sorry, mate. I'm being a dickhead. And you're trying to explain something seriously.
Yeah, like you could die, Luke. All right, you could die, and Claire would be left.
I mean, I'm insured. I'm insured up to the eyeballs, and Claire wouldn't have it any other way. If I go missing anyone on this podcast, you know what's happened to me. It's you know exactly what's happened to me.
Yeah, you know what's happened, and don't check my emails. Claire definitely hasn't messaged me about it. No. No, seriously though. Look, really simply, as you said, we've got 10 minutes. We just used 2 of them talking about your sorry life.
Rubbish.
We need to make sure that we protect the most important assets in our life and the most important people in our lives. So if you add up the amount of income that you earn over your life, it is probably going to be more than anything that you will ever own. And yet most of the time I talk to people who don't have insurance on their life and or their income, and they insure their car, their house, their dog, their cat, their goldfish.
Yeah.
It's unbelievable. That is key. So in this case, what we did is we ran a scenario where either they were going to be short-term or long-term disabled or experience a medical event and potentially die. We ran some calculations against what their current debts were, some medical expenses, some lost income, and we put together basically, an insurance number that we felt would provide them with a similar lifestyle in the event that one of these serious events was to happen. Now, that all sounds really scary, but the reality is it only cost them, I think, a couple of $1,000s each a year. It's not that much. And people shy away from these things because no one really wants to talk about insurance. No one really wants to talk about the bad things. But we always have that conversation because at the end of the day, you're sitting here making financial goals with someone. You're sitting here talking about the things that you want to grow. And that stuff can go away in a heartbeat if you don't plan for the worst case scenario. We're all about risk as advisors,
I think it's so easy, Dill. Like, clients come into me all the time and they, they want to buy shares in company XYZ because they think they're going to get lucky one way or another. Yet, and that's part of it. Maybe not be part of their plans, but they see it as all upside. Yet, I don't. By the same token, if you can get lucky, you can also get unlucky. And we're probably incalculably lucky to be sitting here today talking and being humans, and we're both not a lizard and a spider somewhere or something like that, or a fly and a mosquito. But, we can certainly be, unlucky in the context of our lives and, be hit by a bus analogy, or, like you're going to probably get done fly fishing in a Tasmanian river somewhere, and I'm probably going to get eaten by a shark. But the point is fall off a rock hiking up a hill somewhere. But look, I think the point here is that if you think you can be lucky and you appreciate that you can be lucky, you got to ensure that, if in the future, something bad happens, it doesn't ruin your whole life and ruin all your wife or your partner's life either. So, or your kids, more importantly. So look, I think it's a massively under-discussed, underappreciated area because it's a bit boring, it's a bit administrative, and it's not very nice. But look, I personally feel great that John and Jane are now going to be in a position where they're insulated from bad luck, essentially.
Yeah, absolutely. That's a great way of putting it. Really, really good. So yeah, I mean, I know you got to get to your bit. I know you got to get to your bit, but
bit of me time. Oh,
bit of your bit. But probably to sum all of that up, if we take it back to the bare bones, right? All of those goals are about giving peace of mind and security about something that may or probably will happen in the future. And they're really common
Mhm.
things, right? And it doesn't matter whether you got 200 grand or 2 million or 20 million, right? A lot of people want the same things. And if we can plan for those things, then, we're going to have a much, much better financial outcome, which allows us to do the things that make us happy. Where that
Love
all
it.
comes together
Love
then
it.
is getting them into Mr. Luke Larative's hands and getting them invested, right?
Yeah, look, this is last for a reason, because this is Dill's dealt with the plan and what I'd call the defense, and then I get to come along and play the offense. Like I said, I think the defense probably doesn't get enough attention. It's kind of half the reason why we're doing this podcast. Everyone wants to talk about making money, but no one's talking about keeping it. So
Messi and Ronaldo don't play in the back line, do they? So tell us a little bit about how we've constructed these portfolios and what the different purposes are. So, for context, we've got money sitting in long-term savings, so superannuation savings. And then we've also got money in our what we call current savings, so things that we're planning for that are sooner. Tell us a little bit about how you've put those portfolios together.
Yeah, essentially, we've taken a sort of holistic view over helicopter view of their entire liquid asset pool, and trying to, I suppose, generate the highest level of return we can for the agreed level of risk that we're looking to take for this particular client, that's going to map to their goals. So, they're going to have exposure to all asset classes. So whether that's, fixed income and bonds, Australian shares, international shares, hedge fund strategies, alternatives, full gamut they'll have, and we'll be managing for that for them on a month-to-month basis, making changes to those particular portfolios as we see fit, so that they'll be able to get on with just doing their work and generating income at the highest rate of return that they can possibly do, while we kind of do our job and try and do the same, rather than some sort of other arrangement where, I need to speak to them to be able to make a change and get them a better return. So that's kind of how we've set up the structure. At the moment, we've taken some risk, I suppose, and made a few calls on how we think things are going to go. And that's, investing in global equities and putting a little bit more money in Asian markets where there's a bit of value at the moment, and taking some money out of maybe traditional large cap US equities where growth's been really good and we've had a really good run, but it is concentrated in kind of those 7 stocks that everyone kind of bangs on about, and that's been the large driver of good returns over the last year or two. So trying to find some other more diverse sources of growth for these guys, and all clients, to be honest. And that might be from somewhere like India or Japan, which had really good returns in the recent past, and also some parts of Latin America. So look, it's not just Microsoft, and it's not just BHP. It's kind of things from all over the world from the offensive side. We've also got a fair bit of exposure to fixed income at the moment, and traditional fixed income, so government, corporate bonds, investment grade bonds, because returns are really good, and the numbers look great. And our view is that bond yields are falling, as we discussed at the top of the podcast. So we think in the over the short medium term, that's going to result in some decent returns for these guys, some pretty tax effective returns when we start looking at super and the trust as well, and being able to distribute income and that kind of thing. So really pleased with that. Like that it's holistic, like that we're looking at not just an account, but like all the accounts and all the money. And it's in the context of what they're doing outside of the listed space, with their own home and other property.
I think the really nice thing about the way that sort of these portfolios will come together is the fact that they do all sort of sit side by side. They're not all one. I mean, a question that we get asked all the time is, can we combine our superannuation? Something we can in a self-managed super fund, but you probably don't need to. For these guys, they now have this overall wealth picture that they can log on, they can see everything, and it's incredibly motivating, right? Like, we talk about these behavioral elements of financial planning, but the thing that makes the biggest difference is often being able to actually see your progress and be able to see what's happening. So you're more engaged. I want clients to call me and tell me that they've had a really good day on the markets. It's like, how good's this? Or I also want them to, call and tell me that it's been a shit day and they want to have a talk about it, right? Sticking to the plan makes a huge difference, and it makes it a lot easier when things are all together, all inclusive and aligned with their strategy.
Yeah, I think also just having like daily reconciled, accurate benchmark kind of reporting, that you've got some concept of like what it's going to do for you. You know, what's the right number it should be spitting out every year. What kind of volatility should I expect? What's reasonable? It means you're not going to get caught up in thinking you could or should be doing better, or you're not doing as well as you would like. And at the end of the day, the ability, like all investments, the biggest skill with them is kind of sticking with it and sticking fat when things are a little bit hard, and sticking to the plan, and then not getting too stoked and too overhyped when things are going well.
Slow and steady.
So I think that, just kind of grind it out, and it does work. You've just got to kind of stick to the plan a little bit. It doesn't mean you can't course correct. Doesn't mean we don't make changes. But a lot of that stuff these days, like, that's our responsibility. That's what you pay us for. We sort that for you. So, the main thing with you is to keep those contributions regular, keep the savings up, work on the things that are in your control, and then trust that you've employed people who are deploying a really proven and robust investment process. With institutional grade governance framework that's gonna help protect and ensure that you're going to get close to the outcomes that we promised you.
Yeah, exactly. All right, mate. Well, thanks, John and Jane, for being volunteers to this.
I better check with John and Jane, that they're happy for us to put this out before we do. I'm sure they will. It'll probably be a problem.
Yeah, John, Jane, and their kids, Jack and Jill.
Yeah.
So that wraps up our strategy session, episode strategy number 1. We'll try and do a few of these throughout the year, try and find some interesting client stories, pretty diverse, and sort of showcase what the value of each of these different types of strategies that you can do. And see how it all comes together, I think.
Yeah, I hope you got some value out of that. Hopefully, we've been able to articulate a little bit what we're doing. It's kind of hard to go into specifics or your specific circumstance. So if you think that like debt recycling, or you need some insurance, or you want to have a chat about your overall investments and get a little bit more robust in what you're doing, Dylan and I are here to have a chat with you. I mean, we run this podcast because, one, we like doing it. It's good for a giggle for us. But most importantly, because we're trying to grow our business. We want you as a client. So feel free to drop us an email, give us a call, send me a carrier pigeon, whatever you like. And that's what we do in Tasmania. We'll get some time where you can sit down with Dill, myself, or both of us, and see if we can't help you with something similar. So really appreciate you listening to episode 2 of our podcast. We will promise to try and get better. I know it's not ideal just yet, but we're getting there.
Mate, I'm great. It's you're the problem.
All right, on that note,
thanks everyone.
Next week, do it all again, Dill.
We'll do it all again, bigger and better.
All right, catch you later, mate.
See you, mate. Bye.